Hello and welcome to Wake Up and Smell the Mic S&P 500 review for Monday, June 5th, 2023. It's now the 3rd. We start off in the S&P 500 daily chart in DeMark looking back to end of December 2021. I'll zoom into the current area now. The S&P 500 daily chart has printed the combo and sequential sell setup 5 count. And to negate that for end of day on the 5th, there must be a close below 4205.52 for the price flip to the buy setup count 1. The qualified supply line had the confirmation bar on Friday, and that gave the supply projection at a high level, 5017.78. And that's above the all-time intraday high of this relative retracement up magnet. So when there's another ongoing supply line that gets qualified and or confirmed, then there will be another qualified supply projection price gapped up above the 50% qualified and confirmed propulsion exhaustion up and nailed the upper Stark band. It poked its nose above it for the day on Friday, so I'm sure that the upper Stark band will be a lot higher than that during the day for end of day on the 5th, and price usually will simmer down and have a little bit of a downdraft or a pause. So it takes a lot to puncture the upper Stark band, even though I have it set to where it will puncture it once in a while. For the most part, the upper Stark band and lower Stark band for that matter is repelled by price as it approaches it. And our target is in sight, this relative retracement up to, which could become qualified and confirmed. And if that happens, then there's more upside, and the relative retracement magnet for the all-time intraday high will be the next target. And again, that's at this level here, 4793.54. So to the downside are familiar support levels, the mid-band of the Stark band and the conversion line, then the baseline and the new disqualified trend factor down 1 level, and then the lower Stark band, and right above that is now the disqualified momentum down for 50%. And then there's the channel 3 low, along with this ongoing demand line, which for Monday will be at 4107.52. And a close below that level will qualify it. And the D wave C3 has shifted over once again, and we'll follow up on the special video 17 that I posted about calling a bull market, and I posted that yesterday on the 2nd of June. I'll zoom into the current area now, so you can see the rules here that we must have at least 1 or 2 indexes above 10% to make a bull market, and that's the top line here on all 3 windows. And I actually called a bull market back in February based on the mid cap here and the small cap down here. However, the S&P 500 large cap did not go into bull market. So I would rather have the S&P 500 and the bull market above 10%, and then maybe one or both of these like that, at least one of them And then you can see it promptly went back into a bear market in March. And currently, we're nowhere near a bull market in any three of the windows, large, mid, small. You can see 4%, 6.25, and 3. It has a lot of work to do to get above 10. So we stopped there. And if it was touching up here, any one of these, I suppose, one or preferably two, then we would move on to the 20, 50, and 200 day. The S&P 500 daily pattern chart, formerly called the S&P 500 downtrend line chart. You can see all the downtrends in white that have now gone off to oblivion. So we'll take a look at the patterns. I'll zoom it a bit and look at this. This is absolutely incredible. Price on Friday jumped up above that zone for the top of the super bullish wedge and horizontal support where the Fed made its mistake back in May and July of 2021, between that time frame. And it just jumped up right above it, gapped up, blasted above the top of this broadening top pattern here. So zoomed out, you can see that this is the measure rule target 4414, and the performance for getting up to this number here is 28% of the time in bear market breakouts, which is what this is. And it falls under a short and narrow designation for the broadening top, meaning short in duration and narrow from top to bottom. And there are two other parameters that are working against it, and the first one being that performance is better if the breakout happens within the middle third of the yearly high-low range. So we'll go back to June, and you can see that the yearly range is the top of this candle and the bottom of this one here. And that's around August 15th for the top and October 15th for the bottom. And over here in DeMark, the S&P 500, you can see the middle range here. So here's the bottom one from here to 0. And then from 0 to here is the middle range. And you can see that it's broken out above that, so it's in the upper range. And the second thing that it has going against it is that it gapped up out of the broadening top pattern, and the performance is better if it does not gap up and just closes above it. So that's just the performance statistics. So one would wait until Monday, probably wait till the close to see if it can close above this candlestick on Friday and then get on board. So that would be a good plan if you're looking at the gap rule. And then it has the upper line of this potential perfect uptrend channel. I did reconfigure it. So the top line here for Monday is at 4294.22. And the bottom line I debated on keeping here or actually moving it to the bottom of this candle to eliminate the slice through it here. So we'll keep it here for now, but if the time comes and it gets close to that, I just might move it to the bottom of this candle and wait for the second and third hit. Third hit if there's only 2 up here, second hit down here if there's 3 up here. However, FOMO is making the rules for the market participants, so it could just blow everything out of the water that I was talking about here, as the FOMOs could just run this thing straight up to here and possibly beyond. And this is more than ever a high stakes game of musical chairs. So you had better have a chair strapped to your arse. And I'm going to pick up the pace here to get through the NYA top caller chart, looking at the NYA to SPX ratio, basically value versus growth, and it looks like it was timely that I put the bottom here for growth. And the starting point back here in December 21, then there was many value tops and growth bottoms, and now one that encompasses all of the growth bottoms possibly. And you can see in the thumbnail it hooked around here and went back above this line that designates this bottom, so it went under it a little bit, now it's back above it. And the New York AD line went back above its uptrend line here. A bit of a whipsaw right there, nailed the 200 in red, bounced above it. It's now above the EMA 50 in green. And the ratio adjusted McClellan breath oscillator shot straight up above zero from well below it, around negative 15 or so. And NYA price had a Marty McFly moment there. Look at that candle in the side window here, that white one. Oh, it's incredible. It's huge. Went back above this measure rule from the start of the big W up. So whipsaw below it. Maybe it's back above it for good. I don't know. And the ratio adjusted McClellan volume oscillator, same thing, rocket shot above zero from well below zero, around negative 25 here. The ratio adjusted summation index of the ratio adjusted McClellan breath oscillator improved a bit, 144.94 negative. Same thing with the ratio adjusted summation index for the ratio adjusted McClellan volume oscillator, took a nice bump up, 181.35 negative. They both have a long way to go. RSI 14 had a nice show, a little bit of a double bottom here, and then it shot straight up above the 21 EMA signal line, and now it's above 50. That's another good show. And the on-balance volume has yet to get on board. It has broken below this uptrend line, and dash red is still below it. It needs a big day or two to get up above both of those. It could blast above. It's still below its 21 EMA signal line in blue here, which is right at the bottom of that uptrend line that it fell out under. And all of these divergences are enough to drive you nuts. The NYA price, you can see in the red arrow pointed down for bearishness. The ratio adjusted McClellan volume oscillator for the NYA now pointed up. I added the blue downwards arrow to price just like down here. However, we can just focus on the stocks only AD line here. Same thing as price, has downward trajectories on both the top and bottom. All the other ones have upwards trajectories on the top and bottom. And I suppose it's a matter of time before the stocks only AD line and NYA price get on board with these breath oscillators. So we're going to wait for these to go on an upward trajectory, especially this red one on the top of the AD here. Hopefully there's time for that to happen before the next debacle. And these three breath oscillators, the volume up there for the NYA, and this one here for the New York stocks only, and the ratio adjusted McClellan breath oscillator for the stocks only AD line, scream FOMO. And the intermediate term volume oscillator is still well below zero. It did pop up above its 10 simple moving average in blue. And the ratio adjusted McClellan volume oscillator for the NYA is now back above zero, so you can read this over here and is not so much of a threat anymore. Like I said, a matter of time, hopefully. And the intermediate term breadth oscillator, same thing, turned around above its signal line and headed up towards zero. And there was a nice pause in the instruments in the NYA above their 200 simple moving average within the 40 and 50 zone like I was hoping for. And nice rest, and then popped right above 50. Let's see if it can stay up there and do the same thing now within the 50 to 60 range. The CBOE 10-year U.S. Treasury Yield Index, the TNX, on the monthly chart. You can see in the main window that it went under the 3.5 red line here, and then over in the thumbnail you can see it absolutely nailed the 12-month simple moving average and bounced up back above 3.5, ended the month at 3.691. And I've kind of stopped listening to the Fed and all the talking heads trying to analyze inside their head. But I heard a lot of the speakers or Fed governors came out speaking, saying that a skip might be in order, and I believe a lot of people don't understand what that means and are taking it as a pause. And besides the fact, you gotta wonder, why are they even thinking about a skip? They have really painted themselves into a corner about the 2.0 inflation target, doing whatever it takes, but they can't take that back and give it a higher and more realistic level, like maybe 3.5 to 4. 4 is a little high, so maybe 3 to 3.5 inflation. So if they're really serious about the 2.0 inflation target, they will hike 25 basis points in June and then another 25 in July, and not skip. So if they skip in June, then under the hood and inside their head, they are not serious about the 2.0 level of inflation they want to get it down to, and are just giving us lip service as they can't take it back and give the more realistic level of 3 to 3.5. Get serious and forget about the long and variable lag and hike 25 points in June, and we will take back all the gains that we have just experienced in the stock market. And here's what they are trying to avoid back here in 80 and 81, when they let the interest rates pause or cut or whatever they did back here, and everybody jumped on board with that, and then inflation reared its ugly head again, and it was right back up into the 70 zone of RSI here, right there in 81, late 81. So it's forming that a little bit now. Looks like it wants to get back up above the 21 EMA signal line in blue, but it's pretty much right on top of it, or a little under it. So 63.04, and the 21 EMA is at 63.19. So we are a little bit under that signal line. The ROC 1, ATR2, and PPO extreme chart. You can see the ROC 1 is still experiencing volatility. In the thumbnail, you can see back here it was above 1 positive volatility, then back to under -1, negative volatility, back to above +1, and then now down and then back up again. So volatility, even if it's positive, is still volatility. And there were some huge white candles last couple of days as the ATR2 is above its volatility line at +50, and it's at 60.75 and pointed up. And the PPO Extreme had a really good show, 5.739. It's now in that zone between 4.5 or so and 8.43. Yeah, right here, 8.43. So it's got a lot of room to move around in there. And here's the S&P 500 daily line chart, arrow pointed up and to the right, a D line pointed down and to the right, so there's the divergence there. It had a nice double bounce off here, so I created a trend line here, falling valleys trend line, and it went right back above this other support and resistance level in dashed red, going back to December or November of 21, but it's the downward trajectory on the AD line we have to watch. And the stocks above their 20 simple moving average in the S&P 500 had a nice show. It's back up into the green zone here. Still a bit of a divergence there. I don't know if it really counts, but I put it there anyway. MACD counts way more, so I did move the line arrow over here to this point, so now all it has to do is keep pushing it up until this is in an upwards trajectory and to the right, and that divergence will end. Our SI 14 has already beaten MACD to the punch. It's got an upward trajectory now. And like the NYA, the on-balance volume for the S&P 500 needs to get back on board and start pushing that trajectory up and to the right. The CBOE total put-call ratio chart that I condemned back here on this small dip has started working again, and actually has never stopped working. But by stepping away from the day-to-day noise, we can see that in the long run it is actually working, where the KST is headed down, as you can see in the thumbnail, and price is headed up. Since the last time I gave this dashed green line here, I gave a new one here at that peak. So let's focus on these common valleys here, one on the 29th, July 13th, and October 27th. You can see if I put the cursor's horizontal line right across them, it's at about 0.872, and you can see that tag on the right. So it is a long, slow, torturous drive down to here, but nonetheless is headed that way, as this is the area here that we were focusing on when it took this dip here. It looks like at the end of April, beginning of March. So let's keep at it, and we'll monitor this daily. The S&P 500 support and resistance levels big board chart has reached a milestone now. We've now moved the chart up to show the 4,300 zone, and now we can't see the 3,700 zone. And this was almost akin to having an Apollo 13 moment, where they had to fire up the command module from the LEM when it was frozen in space for so long. They didn't know if it would work or not, and it flickered back to life, so we got some flickering back to life up here. So the gray areas are at levels I do not like to use, but it was the only thing there. The upper start band, which is a moving target, and the daily high channel 3, which is definitely more legitimate than the upper start band. And price in the aftermarket hours for the S&P 500 end of day Friday is 42.82. So to the downside is everything down to around 42.32, this gap zone here created from Friday. And one would think that those are going to be pretty good support levels. And to the upside is the weekly diamond bottom uptrend extension. So that's the original one and not the perfect channel one down here in the 4100 zone. And then our target, the relative retracement up to at that level, and an old top of the range, which gave me the Apollo 13 analogy there. And here's the S&P daily chart that shows those ranges, and you can see the 4305 right here, and it extends back to here, which is the October 21 area before that big run up near the top here. And you can see it was really good support back here, support and resistance in here, again resistance here and resistance here. So I call that a very valid top of the range. So now we're going to use it for the top of the range again. And I gave R1 a green up resistance color there. And the wave 3 up projection is my own. I base it on closes, and DeMark Analytics uses highs and lows, so theirs is a lot higher than this. So this is more realistic for now, and if it exceeds that and keeps going, then we'll use DeMark's high-low. So it's needless to say that the S&P 500 AD line made it back above its 21 EMA signal line, and the NASDAQ 100 AD line created more distance between its 21 EMA signal line, so it's nicely above that. And I moved the trailing 12-month and the forward PE ratios for the S&P 500 down here, and you can see that the 12 forward PE really took a jump up. Between the both of them, we're still well above historical averages for those PE ratios for the S&P 500. I believe they're down in the 16 or 17, low 17s, I believe. And whatever they are, they're very elevated to the upside. And we just looked at the ROC 1, ATR2, and PPO extreme chart, so you can see ROC 1 above positive volatility at 1.00, so it closed there for end of day. Same thing with ATR2 above its volatility line out of the low volatility green zone, and the PPO extreme bounced up very nicely. It's in that range between 4.5 and 8.43 above zero. And look at this New York traditional McClellan breath oscillator to get back to zero would require 2,198 decliners over advancers to get back to zero. That could quite possibly be the biggest jump I've ever seen in one day. Have a great day.